Hey guys, what is going on? Welcome back to the portfolio. Again, I want to thank everyone out there for supporting the channel. If you guys do like the content, if you guys do like the video series, feel free to like, share, and subscribe. And if you are a subscriber, make sure to hit that bell button to get alerts and updates on all new content posted on the channel. For today's video, I want to go through all of the different ways in which you can trade options on the platform. There's been quite a few viewers on the channel wondering what are all the different options, contracts, buying and selling, calls and puts, and then what are the requirements for doing those contracts? Do you need collateral? And if you do not need collateral, what is the obligation to do for that trade? So I thought I'd take a look at AT&T here. This is a stock I will be doing a trade today live for tomorrow's market. I'll be doing most likely selling off a put. I might also sell off a call as well, but let's jump into the platform before we do that to go over all of the different combinations of orders. So if you click on trade in the bottom right hand corner, click on options, you'll see there are a number of different windows up on top here that are highlighted. For example, this particular trade, you are selling off a call. If you sell off a particular call or put, you are obligated to do that particular trade. You cannot choose, you are obligated to do that, but because of that obligation, you get paid into the portfolio an options premium. So you will get money paid to the account in the form of a cash premium for doing this contract. So if you sell off a call is much like SELL, CALL. You are required to sell a stock at a particular price. Because of that, you have to have that stock in your portfolio. Each contract is 100 shares, so you have to have at least 100 shares in the portfolio to do this trade here, sell a call. By doing that, you are obligated to sell off a stock at a particular price, and you get an options cash premium to your account for doing that. Likewise, if you sell off a put, you are obligated to doing this contract no matter what. You get a cash premium to your account. This time you are obligating yourself to buying a stock. Again, PUT is much like BUI. So you're obligating yourself to buying a stock at a particular price. And because of that, you get an options premium to your account. Now, if you take a look at the other side of the coin here, buy, you're simply doing the opposite of the sell order. So that's how I kind of think about what we're doing. It's a little bit more complex with the buy orders. So again, I think of it as a sell call. If you're selling off a call, you are obligating yourself to selling a stock at a particular price. So if you think about the other side of that coin, this particular investor has the right but not the obligation. That's a big difference between buy and sell of buying the stock at a particular price. Again, if you sell off a call, you're obligated to selling a stock off at a particular price. If you buy that contract, then you have the right but not the obligation to buy that stock from that other investor. And because of that right but not obligation, you have to pay money for that contract. You do not get an options premium. You do not get cash into your portfolio. You actually have to pay for that, but there is no collateral required. You simply pay that fee for making that contract, and then you can choose to exercise that or not. So the person buying the contracts are the ones who are exercising the contract or not. The sellers have no choice on that. They are obligated to doing the contract if the strike price is met. Likewise, if you sell off a put, again, you are required to buy a stock at a particular price. So if you do the opposite of that, buying the put, then you have the right but not the obligation of selling your stock to another investor at a particular price. Again, for that, you do not get an options premium. You actually have to pay money from your account to Robinhood for making that contract. So those are all four of the contracts. Again, if you think about it in the context of selling off a particular options contract, selling a call, you're obligated to selling a stock off at a particular price. If you're selling a put, you're obligated to buying a stock at a particular price. And then if you take the opposite of that, if you're buying from a person who's obligated to sell, then you have the right but not the obligation to buy. If you're buying a stock, or excuse me, an option from a person who's obligated to buy, then you have the right but not the obligation to sell that stock to the other investor. I hope that makes sense. I tried to go through that a couple different times just to kind of solidify exactly what we're doing with all these contracts. So now for the trade today, let's take a look at the different contracts I can do to give you guys a sense of the collateral as well. So for example, selling a call, I want to sell off shares of my AT&T at a particular price. You can see the current price here in the middle is $32.30. Let's say this next week, July 6th, I want to sell off the stocks for $33 per share. I can do that contract. I'll do one contract. Again, one contract is 100 shares. I'll get paid $2 to the portfolio. But you'll see here that I'm now obligated to have collateral of 100 shares of AT&T. I can't buy and sell those. They are tied up in this contract. I would have to buy this contract back in order to start trading those shares again. I'd have to be the buyer of the contract to do that. So you can see on the bottom here, I'm agreeing to sell 100 shares of AT&T at $33 per share before or on July 6th. If you aren't asked to sell T by then, you'll keep your collateral and the full $2 credit. So that is how you do a sell call on the particular application. Let's do a sell put. I'm going to be obligating myself to buying a stock at a particular price. Let's take a look. Again, the price of the stock is $32.20. Let's say I want to buy the stock at $32. Again, I'll do one options contract. Now you'll see on the bottom, the collateral is $3,200. Essentially $32 times 100 shares. The credit, $12 to the account. I'm agreeing to buy 100 shares of AT&T at $32 per share before or on July 6th. If you aren't asked to buy AT&T by then, you'll keep your collateral and the full $12 credit. So that is what's happening with both of these trades. Again, let's go ahead and do a trade with AT&T here. I'm going to be selling a put. Current price is $32. I'm more than happy buying this stock back at $32 a share. Let's go ahead and do that. $32. Let's do 7 contracts. $84 credit to the portfolio. You can see the collateral there, $22,400. There is a holiday week this week, so there's only 3 more days of trading. I'm very happy with buying back or potentially buying back this particular stock at $32 for an $84 credit. So if I swipe up, you can see now that contract has been made, and then tomorrow when the market opens, hopefully this trade executes and I go ahead and buy AT&T at $32 a share. So those are the ways in which you can trade options on the platform. Again, I just wanted to quickly go through this as there's been a number of viewers on the channel wondering what are all the different combinations of options contracts on the portfolio. So if you guys have any questions about that, please let me know. I went through that very quickly. But again, I just wanted to show you guys all of the different combinations and how I remember exactly what we're doing with each of those different combinations of buying and selling, puts and calls. So again, if you guys have questions, please leave them down below. Not to make the video too long, I'll kind of end it here. Again, if you guys enjoy the videos on the channel, if you guys enjoy the video series, feel free to like, share, and subscribe. And until the next video, we'll see you then.